Welcome to Financial Management, Essential Concepts for Subscription Businesses. So let's take a look at the concept of revenue recognition in the simplified fashion. We're not going to do a dissertation on all the nuances of revenue recognition. We're going to deal with it conceptually to make sure that everyone who's using the system understands some core concepts. So revenue recognition is a cornerstone principle of accrual accounting. And the whole intention of doing accrual accounting, or the whole purpose, is to create GAAP compliant records. So accrual accounting is essential for doing GAAP compliant accounting. It's not necessary for all tax reporting, accounting, and for other types of financial reporting, but for GAAP reporting, you really need to be doing accrual accounting, and revenue recognition is a cornerstone of that. The key concept is that revenue is recognized when it's earned, regardless of when it's invoiced, regardless of when the cash is received. This is a point that has to be drilled in, so I'm going to say it again. Revenue is recognized when earned, regardless of when invoiced or when cash is received. So for a subscription, revenue is earned as you deliver the solution over the subscription period. So we're going to recognize the revenue over the subscription period, and because of that, this requires special bookkeeping practices, right? And in doing so, when you're doing this management, you must manage both the invoicing and the revenue. You can no longer just manage the invoices. You must now manage the invoices and the revenues. So if your job were just managing invoices before, now your job is managing invoices and revenues. So let's take a look first at the bookkeeping of it. And I'm going to use, obviously, some QuickBooks examples here because most of our clients use QuickBooks, and if not, most people understand QuickBooks. We're going to get into a conceptual discussion in a few minutes about revenue recognition. I'm going to start with this approach because I think for some people who are mired in the details of working in QuickBooks, this might be a simpler, clearer, easier explanation, just related to the practical things that you're using day in and day out. So on the left, we have our traditional business, and on the right, we have our subscription business. So in our traditional business, we create an invoice, and that invoice will create a credit to a revenue account. So in QuickBooks, that's called an income account. Technically, it's a revenue account, or you can call it an income account. It doesn't matter. It shows up on your income statement. It's revenue. It is your sales, basically, right? So we're going to put a positive number in there. If we sell a widget for $100, we're going to show $100 of revenue on our income statement. At the same time, since we're issuing an invoice, we're going to debit our accounts receivable. This is an asset account on your balance sheet. This is a claim to money owed to you by the customer. So you put $100 into sales and you put $100 into accounts receivable. Now in a subscription business, it's very different. When you generate your invoice, we put a credit to deferred revenue, which is a liability account, and it's a balance sheet account. So rather than putting the $100 in sales, or revenue, we put the $100 into deferred revenue, which is a liability account on your balance sheet. We also debit accounts receivable. In other words, we add the $100 to our AR. That's an asset. Again, it's an obligation by your client to pay you that $100 in the future. Now, what's interesting, if you look at this very quickly, is we're doing a credit and a debit to the balance sheet on the subscription side. On the traditional business side, we're doing a credit to the income statement and a debit to the balance sheet. All right. So how do we get revenue onto our income statement in a subscription business? We will periodically debit our deferred revenue account or accounts, and we'll credit our income accounts or our revenue accounts. So when the invoice is issued, everything goes on the balance sheet. And then we draw down our deferred revenue. As we earn our revenue over the subscription period, we draw down the deferred revenue and we put it into sales/revenue/income accounts. Okay, let's take a look at that with some QuickBooks screenshots. So the bookkeeping for a traditional product, you set up your items. So in QuickBooks Desktop, they're called items. QuickBooks Online, they're called products. But in both, you have a name. In this case, I called my product, my item, just product. I could have called it widget or something. It doesn't matter. and I associate it with an account. The default mechanism or default behavior for QuickBooks is to put your products in income accounts. So this is a default name, sales income, that comes with QuickBooks. And when you generate your invoice over here, you pick that product or that item. In this case, we called it product, quantity 1, widget, and it's $3,000 rate, and the total amount of the invoice is $3,000. So what happens on our income statement, or what we also call our P&L, income statement and P&L being the same thing, what happens there and what happens on our balance sheet? Well, per the slide a couple of slides ago, we will record $3,000 into a revenue account, in this case called sales income, and we will record a $3,000 accounts receivable here on our balance sheet. So we have $3,000 as an asset in our balance sheet, which is a claim to money owed to us through the invoicing, and we record $3,000 of revenue in January. Nothing in March, nothing in February, etc. Now, over here you'll note, I'm doing this for a quarter, by the way. It's a one-year subscription example, but I'm doing it for a quarter to keep the amount of content on the screens down. But you'll see here that in my example, the accounts receivable, $3,000, remains open through the first quarter. A key concept, again, is payment doesn't really make any difference when they pay and how they pay, and quite honestly, even if they pay, assuming there's a high degree of probability of collectability, it doesn't really matter if they pay, right? Really, if they pay, the $3,000 comes out of accounts receivables and hits another asset, which is cash. So once they pay, the $3,000 comes out of AR and goes into cash, but it remains on the top side of your balance sheet. You're just swapping out one asset, which is a claim to money, for another asset, which is actually the money. Now, in a subscription setup, you set up an item. I'll call it subscription. This would be your product name or your solution name. And over here under account, I've selected an account named deferred revenue. Now, deferred revenue is set up as an other liability account in QuickBooks. Again, it's a balance sheet account. My invoice, really nothing changes on my invoicing side. I pick a product, in this case subscription. I put in a description, a rate, and an amount. And this time I used $1,200 to keep it slightly different. So my invoice looks the same, but my setup is different. So what happens to my income statement, P&L, and my balance sheet? Well, because we're crediting and debiting on the balance sheet and not on the income statement, there is no entry here. We have zero. In fact, this is an income statement with no records whatsoever. So it's 0, 0, 0. I've recorded no revenue, no sales. What I've done is I've put $1,200 into accounts receivable, and I put $1,200 into deferred revenue. So I have a deferred revenue of $1,200 here. Now, if I don't do anything else, it'll stay like this in perpetuity. I may swap out my $1,200 receivables for $1,200 cash, which might be above here, and this will go to zero. But my deferred revenue is going to stay at $1,200 in perpetuity unless we do something. So how is it that we get our deferred revenue, which is what we've invoiced here in excess of the revenue that we can recognize? How do we get the revenue out of here and over here? Well, we do it through journal adjustments. And in SaaSOptics, we give you the reports to generate those journal adjustments, and we typically do it by month. Now, important point, we're talking concept here, not details. In my example, I have one client, I have one entry, and I'm using that as an example to keep the numbers really crystal clear. When you do journal entries, we do them at an aggregate level. In SaaSOptics, we give you the aggregate journal adjustments to put into QuickBooks, not the customer by customer journal adjustments. We give you the customer by customer deferred revenue and the customer by customer revenue and all of the backup needed, but the entries themselves are done at an aggregate level. In my example, I only have 3 journal entries for my one example. So in January, on January 31st, I'm going to debit deferred revenue, which is I'm going to take away from deferred revenue $101.91, and I'm going to put it into my income account called subscription revenue. I'm going to do the same thing in February and in March. Now, I'm going to do a slightly different amount in February because there's 28 days in February. So we're going to generate our revenue schedules and the amount of revenue that we can recognize based on a best practices approach, which is to do it ratably over the term based on the number of days in a period. In this case, we're doing it by month. We have 31 days in January, so we have 31 of 365 times our $1,200. It results in 101.91. 28 days in February, 31 days in March, and those are the journal entries. So what does it look like on our income statement, P&L, and our balance sheet? You can see now nothing's happened to the accounts receivable. I don't really care about the accounts receivable. For purposes of revenue reporting, it doesn't really matter. So whether it's paid now or 3 months or 6 months is a separate issue. If it's uncollectible, there's a whole process for dealing with bad AR, which is distinct from the process that we're using here for revenue recognition. What's important here is the change that goes on between deferred revenue and our income statement subscription revenue. And very simply, what we're doing in January is we're taking our $101 here out of what was $1,200 here. So we were at $1,200, we're taking $101, we're throwing it into the income statement. Come February, we're going to take and draw down another $92.05. So we reduce the balance of our deferred revenue to just over $1,000. And then in March, we take out another 101, and we reduce the balance of our deferred revenue in our balance sheet. So between January, February, and March, we extract a total of $295.88 from our deferred revenue. We do it month by month, and as we draw that down, we record our revenue here, and we reduce the balance of the $1,200 that was initially put in the deferred revenue. Okay, so that is the concept. Now, again, this is a conceptual presentation. Some clients, this is really the best practices approach for setting up your items and doing it in QuickBooks. Sometimes people don't put their sales into or their items into a deferred revenue account. They just leave them in a sales account, and they do a monthly journal adjustment to take all of the sales out at the end of the month and put them into deferred revenue, and then they go back and add these journal adjustments just as I've done here. There are a couple other ways that you can do it. The one I'm showing you here is by far and away the most popular. The one I just described is the second most popular, and the third and fourth are so infrequent you don't want to be doing one of those, so we're not going to cover them. Now let's take the discussion to a conceptual level. So if that didn't resonate with you, maybe the conceptual will. And to start with the conceptual, we're going to take a step back and up and look at the concept of a contract subscription agreement. So this is a license agreement, subscription agreement. This is the legal document or documentation that defines the relationship between you and your customer. So the typical subscription agreements can name the parties, will have warranty clauses, indemnification clauses, choice of law, all kinds of prescriptive legal terms to define how the relationship is going to be governed in a court should something happen. Okay. The contract also includes some other really important things. The specification of a term. So term quoted here means the period of the subscription. And the agreement will have something that specifies the term. Sometimes it's a start date and an end date. Frequently it's a start date and a duration. So contract will start on July 1st and will run for a period of 1 year. The contract will also specify the end of term actions. So what happens at the end of the term? Does the agreement auto renew? Does it cancel unless there's notification? Is notification required by either party, etc.? So these are renewal terminology and legal terms that are in the term section of your subscription agreement. Now in the subscription agreement, you'll also have what are called contract elements. The contract elements are the products, solutions, etc. that you sell, license, subscribe to people. And the subscription agreement will include the costs and the prices of those contract elements. Typically, you're going to see either one or several subscription items. So your business, you may have one item that you sell, that other businesses have a land and expand model. They may have multiple subscription products that are licensed to a client at one time. But the general category of subscription items falls into the terminology of recurring. So the subscription recurs or is delivered over time as well. You may also have one or more non-subscription items. These are non-recurring one-time things. Training, professional services, setup fees, one-time license fees. You don't see too many of that these days, but anything that doesn't recur is what we call a non-subscription or non-recurring item. You may also have consumption fees, overage fees, etc., extra user fees. These are called variable fees. So your contract's going to cover the things that are typically, quote, subscription items, and then those things that are kind of one-off. Your contract's also going to provide invoicing and billing and payment terms information. So you're going to invoice up front, invoice quarterly, invoice monthly in arrears, and your payment terms, net 30, due upon receipt, etc. So one thing people do get confused about often is term. The word term is used so many different ways. Payment terms means one thing, and subscription term means a completely different. So just be aware as you're using the system that we use the term to refer to the overall period or relating to the period of the subscription. So now to the heavier stuff. Different revenue recognition methods apply to the different contract elements. So this is a really important concept. And you got to get your head around this as well, because this is the essence of the revenue recognition. Is the recurring items are almost always, almost by definition, they're subscription items that are recognized pro rata over the term of the agreement as the solution is delivered. So we may charge the client $12,000 or $1,000 or $100,000 upfront. Maybe it's paid in cash, gold bullion, credit card, wire, doesn't matter. But over the period of the term, in this case maybe a year, we're going to recognize the revenue ratably over that period of time. Okay, and that's pretty straightforward. Most people get that. Non-recurring items can be recognized all up front. They can also be pro rata recognized over the term, and can be recognized over some period other than the term. We've seen plenty of examples of something like a setup fee being required to be recognized over a multi-year period, even though the subscription term might only be 1 year. So auditors and accountants will tell you what the period for recognizing something like a setup fee will be. Professional services can be recognized as delivered, sometimes after delivery, maybe over a fixed period, so ratably over a fixed period, or through other mechanisms. Usage fees are typically recognized and incurred when they're invoiced, and perpetual licenses are also typically recognized all up front. However, again, your auditor will be the final say in terms of how you do your revenue recognition for the different contract elements that you have. Typically speaking, recurring items in your contract are going to be recognized over some term, and typically non-recurring items are going to be recognized at a point in time. However, with frequent exception, some non-recurring items will need to be recognized ratably over a period as well. That really throws people sometimes, and it's an essential concept that you need to really get your head around. Let's go to the next slide. For managing revenue at a comprehensive level, you need the following information. You need a customer. You need a contract. So a contract is an object that doesn't exist in the world of QuickBooks. It exists on paper with or electronic form as a way to document the relationship between you and your client. But the contract is also an important container around which revenue is recorded and recognized per GAAP. So the contract will have contract elements, and we will need revenue schedules, and we will need invoices and invoice line items. So these are all objects that are required in order for us to do a revenue recognition. Really important concept here. Revenues and invoices are distinct objects. I could say this 500 times in this presentation, and hopefully you'll finally get it. But if you don't get it, you'll struggle enormously with SaaSOptics or any other system that's doing revenue management. An invoice is not revenue, and the timing of an invoice does not affect revenue. This is an essential concept with accrual accounting. Right? The revenues are earned as the solution is delivered. It doesn't say the revenues are earned as the solution is delivered when invoiced. It's just the revenues are earned as the solution is delivered. So an invoice is not revenue, and the timing of invoices does not affect the recording of revenue. Revenue is not an invoice. The timing of revenue does not affect the timing of invoices. You'll see in a little bit that we can have a subscription that begins, and we can begin to record revenue or report revenue to our shareholders, and we haven't even invoiced the client yet. And that's the greatest example of why they're disconnected. And if you think about that, if you understand that, move on. But if you don't, maybe you want to pause this for a second and think about what I just said, and I'll repeat it. You could start recording revenue for a subscription that you haven't even invoiced yet. All right. So with that, let's go on to talk about revenues and invoices in financial statements. So what is revenue in a financial statement? It is the total of all of the recognizable revenue in a period from all of the revenue scheduled across all the customers. That's what you report as revenue. It's in the income statement or P&L, and it's very typically broken down by category. So for subscription businesses, you almost always see a line for subscription and another line for professional services or other fees. Typically, you'll see two, sometimes three, sometimes four, but you will always see the subscription revenues broken out from the one-time revenues. And this is just a kind of standard practice for reporting for subscription companies. Revenue is not affected by the timing of invoices. So I've now said it 30 or 40 times. I'm going to keep saying it as many times as I can. Revenue is not affected by the timing of invoices. So what's deferred revenue? Deferred revenue is calculated differently from revenue. Deferred revenue is within a contract. So notice the word contract here is highlighted, and it's very important. If we were to go back to the previous screen, remember that contract object in the middle. That's the object around which we calculate our deferred revenue. So we may have one or more contracts with a client, but we're going to calculate deferred revenue within the contract. And the deferred revenue, very simply, and it's a strange term. If somebody came up with a different term that maybe was more descriptive, it might mean something to the those of us who haven't been to accounting school. But very simply, it's the excess of invoices. So what's been invoiced in excess of the recognizable revenue at a point in time. And it is reported as stated in the balance sheet as a liability. So why is it a liability? Well, we have a liability to provide to the client a solution over a period of time, right? So the client, in this case, we'll use an example. We were paid $10,000 on day one, and now we have to deliver a solution over a year for that $10,000. So we actually have a liability. We have a financial liability to deliver the solution over time, okay? So we've received the money, but haven't, or I shouldn't say we received the money, that contradicts everything I said before. We received a claim to the money by way of an invoice, $10,000, and now we have an obligation to deliver a solution. So that's the general way that you can think about it as a liability, is an obligation to continue to deliver the solution through the term. Now, deferred revenue is affected by the timing of invoices and the schedule of revenue, because deferred revenue, by definition, is the total of what's been invoiced in excess of the recognizable revenue at a point in time. So unlike revenue that's not affected by the timing of invoices, deferred revenue absolutely is affected by the timing of invoices. And this is why, and as well with the revenue schedule. So you can't calculate deferred revenue without understanding invoices and revenue schedules, which is why in SaaSOptics we generate invoices and revenue schedules, which is why when you're using SaaSOptics you have to be cognizant and aware of not only the concept of invoices and managing invoices, but also the concept of revenues and managing revenues. Now, deferred revenue has a cousin called unbilled AR, which is also sometimes referred to as contra deferred revenue. You might see it referred to as accrued revenue. And this is the example I talked about where we are recording revenue and haven't even billed a client yet. So within a contract, unbilled AR is the revenue that is recognizable in excess of what has been invoiced at a point in time. Most subscription companies will say that they don't have this, And in reality, we find 90% in fact do have unbilled AR at some point in time. Unbilled AR is reported on the balance sheet as an asset. So if you think about the liability, we've invoiced the customer and we have an obligation to deliver the solution for the rest of the time. The asset is we haven't invoiced the client yet. So we have a claim to a future invoice, and that would go onto the balance sheet as an asset. And like deferred revenue, it is absolutely affected by the timing of the invoices and the timing of the revenue schedules. So unbilled AR will occur for most people under a number of different circumstances, typically a negotiated payment schedule. Billing in arrears, by definition, it results in unbilled AR. But quite honestly, most frequently for most clients, it's one of two things. It's a negotiated invoicing schedule with a specific customer, or it's a mistake. We forgot to invoice, or we weren't sure we were going to invoice, and so we waited, or the customer asked to be invoiced in the next fiscal year, and we accommodated that with a 90-day out invoice. So we delivered the solution in December and didn't invoice the customer until February so they could deal with their budgeting and internal processes, and that's where you end up with unbilled AR. Now, the last point I've made before, and I'll make it again, payment. The timing of the payment of invoices is irrelevant in reporting revenue, deferred revenue, and unbilled AR. So there's a whole, you can go get a degree in accounting and learn about the topics, and somebody could come up with many examples of where this statement is false. But again, we're doing a simple overview of the finances of a subscription business, and generally speaking, the timing of payment of invoices is going to be irrelevant in 99% of the subscription businesses, B2B subscription businesses out there. If you have a B2C business and collectability is in question, then maybe this particular statement isn't as broadly relevant, but we typically are dealing with businesses that have at least term subscriptions in them. If they have monthly subscriptions, it may be along with the term subscriptions. And so this comment is generally speaking accurate for 99% of the people who would be watching this overview. So let's take it into a detailed example here. And the detailed example is going to have some illustrations and representations of data inside of SaaSOptics. So in this example, I have a contract and one initial term. The contract signed on 6/1. It has a single element, meaning a single subscription item. So here we're not going to deal with one time, just going to have a single subscription item. And we have a 1-year first term, which is July 1, 2015 through June 30th, 2016. The $12,000 commitment, that's the contract element. For that item, there's a $12,000 commitment. And the contract says that the subscription will be invoiced immediately upon execution. So we're going to invoice the client for $12,000 on 6/1, a month prior to the subscription beginning. Now, in my example, because I'm going to try to, mentioned earlier on, we're going to start rudimentary, and then we're going to go up rapidly into more complicated topics. I'm going to complicate things significantly here by including an onboarding process. So we get the contract signed on June 1. The subscription starts on July 7th, maybe that was negotiated. And then there's an onboarding process. Maybe it's provisioning of the equipment. Maybe it's configuration. Maybe it's loading of data. It could be any number of things. But the client doesn't have access to the system in a usable fashion on 9/1. And therefore, in our example, you can't begin to earn revenue because you haven't delivered the solution. Even though the subscription started, you recognize the revenue when you earn the revenue, when you're delivering the solution. So the delivery begins on 9/1. And then we're going to have a renewal term. So after the first term, the client's going to renew for another 1-year term at I guess it's a $16,000 commitment, a little typo in my presentation here. And in this case, because they upgraded, not to $160,000, but to $16K from $12K, we negotiated a billing schedule for them, and we're going to bill the client in arrears. So here is our first initial term. We have an invoice for $12,000 on June 1st, 2015. Our subscription starts July 1 and runs for a year, and it's $12,000. Our revenues are recognized starting September 1st through the end of the term, which is June 30th. And you can see we go up and down and up and down and up and down based on the number of months. So in this case, we're going to recognize not over a 12-month period, but over a 10-month period. And so we'll recognize the revenue based on the number of days in the month ratably over a 10-month period, even though our subscription is 1 year in length and starts in July. Now, a quick note on this, for those of you who are wondering, what is this? This actually happens quite frequently. There are two ways to write contracts for subscription businesses, generally speaking, when you have an onboarding process. One is to set the subscription start date to be the same as the acceptance date here, in which case the subscription would start on 9/1 and run for a period of 1 year. And the other method, and quite honestly, this is the less used method, but better for my example, is this example where the subscription period is defined. What we don't know is the onboard go live date, because we have delivery things to worry about and take care of before we can figure that out. But we've already fixed the end date. So the most popular is you don't fix the start date and you fix the duration, and you start the subscription at the point when the client can begin to enjoy the benefits of it. The other model is you fix the end date and you kind of squish your revenues inside the period from when you go live to the end date. What does that look like in SaaSOptics? So here's a screenshot, and we have a single transaction with a start date of 7/1 and an end date of 6/30 for $12,000. That's the contracted amount. We have $12,000 of revenue scheduled. We have $12,000 of invoices. Here's our revenue schedule over here on the left, and here's our invoice schedule. It's just a single invoice on June 1st. Now let's look at the revenue schedule. Here is the revenue that we're going to recognize month by month by month, and you can see it goes up and down based on the number of days in the month. February is the easiest to understand because it's stuck between 2 days with 2 months with 31 days. But you see it go up, down, up, down, up, down. And over time, we recognize we have all $12,000 of the revenue has been scheduled over these months. The next column is the recognized revenue aggregation at a point in time. So at the end of the first month, it equals the same amount as in September. By the end of the second month, we've aggregated the first 2 months, and now it's 2407. Now we add the November revenues, and now we've recognized 3,500. So over time, we're recognizing an aggregate amount. Eventually, we will recognize the whole $12,000. The inverse of that, this is why I'm explaining it this way, is really the concept of deferred revenue, right? So if we're recognizing a little bit over time to get to $12,000, the concept of the deferred revenue is the inversion of that, is we're going to draw down the $12,000 completely in a totally inverted method. You see here, we'll draw from, we started with 12,000 on September 1, but at the end of the month, which is what's shown here, we're left with 10,816 in deferred revenue balance. Then the next month we record revenue and we drop the deferred revenue down to 95. And you'll see these numbers match. 8 matches the 8, the 7, the 7, right? And over time we get drawn down. So as the contract is fully delivered, we go ahead and drop our deferred revenue balance to 0. So we put everything in deferred revenue because we invoiced ahead of our revenue beginning, and then at the end we've recognized all of the revenue. And now remember the definition, what has been invoiced in excess of the recognizable revenue at a period of time. In June of 2016, nothing, because we've recognized all the revenue and we've invoiced all, so we go to a 0 deferred revenue balance. So now we come to our renewal. Our renewal again is a 16K renewal, not 160,000, but 16K. And you can see in this case, we're going to recognize our revenue over the whole period. So now our revenue recognition schedule goes for 12 months. And we've come up with this very funky invoicing schedule just as a point of example. We've just agreed to this with the customer. We're going to invoice 2,000 on October 1st, and then 3,000 5 months later, and then 5,000 and then filing with 6,000 right before the the end of the term. So it's just a kind of a crazy invoicing schedule to drive home the point of what happened. So in this example, in these months here, I have revenue that I'm going to record and I haven't invoiced yet. So I'm going to have unbilled AR. So let's take a look at that in SaaSOptics. So here we now have a second transaction. Starts on July 1st, 2016, runs through July 30th, 2017 for $16,000. Here's our invoicing schedule over here. And here's our revenue schedule and revenue information. So no change here. Through June, we're recognizing the $12,000 over a 10-month schedule. Now in July, we're going to a higher amount because we've renewed and we've upgraded. So now there's more revenue, but it goes up and down based on the number of months. Okay, and here's our aggregate amount of revenue that we're going to recognize over the period. So at the very end, you would expect us to recognize 28,000. 12,000 plus 16 is 28,000. And you see our deferred revenue schedule that we had before, but you'll note here we now flip to unbilled AR. We flip to unbilled AR because we're not invoicing the client for months. So we start recording revenue here in July, and we haven't billed a client yet. Now you'll see how the unbilled AR balance goes up from 13 to 27 to 4,000, and then it goes down. And the reason it goes down here in October is because we've sent the client an invoice. Okay, then it goes up again and up again and up again, and then it goes down in February because we've sent the client an invoice. Okay, then it'll go up again in March, down again in May because we sent the client an invoice, etc. So this is how you will see unbilled AR manifested in an agreement. And of course, if the second term were just really the first term, you would just see this and not the leading stuff here. And you'll see that occasionally inside of your contracts based on the way that you've negotiated your invoicing. All right, last topic and a quick one, reporting. In SaaSOptics, we do two types of reporting, and this is really, really, really important in the context of RevRec because there's some can be quite a bit of confusion. So the first is that we do financial reporting. So we have really two groups of reports called analytics and finances. So our financial reporting reports are defined by very specific rules from GAAP. Okay, so GAAP being the historical phrase, there's some movement towards an international standard, whatnot, but people generally speaking still refer to as GAAP. And there are rules that define how you generate your financial statements. These financial statements are your income statement and your balance sheet, and there are rules about tying and balancing. So we report revenue, deferred revenue, and unbilled AR. That's what we do in SaaSOptics for you in our financial statements and financial reporting that we do. On the other side, we do analytics. Analytics are just as important to running your business, probably more important to board members and product managers and whatnot than even your basic financials, because sometimes they really give a much better indication as to what's going on in your business. But it's really, really, really important as you move into the world of subscription analytics to, especially if you're a finance person, to understand there are no rules. There are no rules for analytics. Nobody defines how they work. You have to use your best judgment, and you have to be able to defend your definitions and decisions about how you calculate things. Analytics and metrics rarely tie, and they rarely balance. And that may be an overstatement. Sometimes they do tie, sometimes they do balance, depending on what you're looking at. But quite honestly, more often than not, having worked with hundreds of customers, this is an area of consternation for most people. An analyst will be asked to run an MRR report or a CLV report or a customer count report, and they don't tie to some other report. But if you take a step back and you think about bookings in your own business and how you define bookings, you probably have 3 or 4 definitions of what bookings are. You have a board bookings, you have a C-level bookings number, you have a sales bookings number. You get different bookings numbers. This bookings number, we include new sales. This bookings number, we don't include clients that came back within 90 days. But for commission purposes, we do commission sales reps as if they were brand new clients. So that is a booking, da-da-da-da-da. For churn, we don't include clients that churn because they went bankrupt. But we do when we needed to churn number for doing a super high level calculation like customer lifetime value. We needed a more pure churn number. So we have a renewal rate, somebody's comped on renewals, so therefore all of a sudden there's discussion, negotiation, and you get different numbers for different ways that you calculate churn, renewal rates. But these are the key things that you will be measuring for analytics: bookings, churn, MRR, and lifetime value or customer lifetime value. Now in SaaSOptics, it's really important to understand that in the financial reports, now that we've spent all this time on revenues and invoices, it's really essential to understand that we use customer contracts and we use the revenues and the invoices to do our financial reporting. So we figure out how much revenue is to be reported, what the deferred revenue and unbilled AR balances are by using these data sources. For analytics, we use the transaction. We use the transaction start date. We use the transaction contracted amount, which is the transaction amount 12,000. We use the transaction end date, and we use an analytics number called MRR. In this case, we had a subscription for $12,000. It's $1,000 MRR. Up here you can see revenue. So here we have a revenue number, here we have an MRR number. Over here we have 1.3K MRR. So our revenue number runs, in the case of the first term, over 10 months, but our MRR number runs over a period of a year. Okay. Now, the point of this is that the MRR number is not the revenue number. Now, there's a method for dealing with this particular thing called CMRR, which would put the 1K here as CMRR, and then 1K here. But in this case, you're splitting up the revenue over the term and normalizing it to a value of 1,000, whereas here you're recording revenues. So MRR is not revenues. That's a kind of key point, which is the last slide here. This is the biggest point of consternation for finance people when dealing with subscription information. And whether you want to agree with this or not agree with it based on your terminology is largely irrelevant, because when you're using SaaSOptics, it's really essential not to mix the two. Revenue is not MRR in SaaSOptics. Revenue is a well-defined finance term. It is for revenue recognition. We've talked about all these things. It equals the revenue. We want to have revenue balance out to invoicing, okay? And for best practices revenue recognition, you're going to get fluctuations in how much revenue you recognize every month. Now, you may use a different revenue recognition methodology, in which case your monthly reporting revenue looks like your monthly recurring revenue. MRR, by the way, is monthly recurring revenue, not monthly reporting revenue. But your monthly recurring revenue may look like your reportable revenue based on your RevRec methodology. But if you use best practices, it's not. It's going to look like this. So here's our revenue based on the number of days in the month and the term, which runs from May 8th through May 7th. So we have just a little bit here at the end. It's $57 down here at the end of our thing. But over that term, we have $250 of MRR. If you look at that, there are 13 periods between the beginning and end of this. We start in May and we end in May. That's 13 months. And for analytics purposes, we would say we have 250 MRR for each month of the term. So if in very simple fashion, to drive home the point, if you multiply 250 times 13, it's 3,250. But we're going to report $3,000 of revenue. So MRR is an analytics term. It is a way to normalize contracts so that you can look at growth and you can avoid seeing these fluctuations, which you will get significant fluctuations month to month. Between January and February and March, you go from 31 days to 28 days. You have a almost 10% fluctuation in reportable revenue just based on the number of days in that period. So you can see here, you have 250 and you go down to 230. That's $24 difference. So it's just short of 10%. So you have fluctuations that then would indicate some change in your business when in reality there isn't a change. That's why we have the concept of MRR. It's the ability to normalize and remove fluctions that appear due to accounting practices that don't really reflect changes in the business. It also gives us the ability to compare dissimilar terms. I can have an 18-month term and a 12-month term, and I can normalize them to MRR and begin to compare them as well. So MRR is a term that means a specific thing. In SaaSOptics, it's actually a field for a transaction, Whereas in SaaSOptics, revenue is a table of schedules, even for all the way down to the transaction level. So the individual transaction may have many revenue entries, but only one MRR value. So when you're working with SaaSOptics, at least with SaaSOptics, get in your mind that revenue is not MRR, and MRR is not revenue. And we use analytics reports to report on MRR, and we use finance reports to report on revenue. And that concludes the long, detailed overview. If you need to watch this again, please do. If you're not comfortable with these concepts, trust me when I tell you, you will struggle with SaaSOptics or any other system designed to help you manage revenues and to do GAAP compliant reporting on your income statement on the revenue side. Because these concepts, while some of them are nuanced to the way we implemented SaaSOptics, are essential to just the overall concept and process of managing revenues in a subscription business.